Once again. In this video, I will be talking about depository institutions' liquidity risk exposure. That means how do we measure liquidity risk exposure of depository institutions. As we discussed in the previous video, that a depository institution's liquidity risk can arise from a drain on deposits or from a new loan demand or from the subsequent need to meet those demands through liquidating assets or borrowing funds. Therefore, a depository institution's manager must be able to measure its liquidity position on a daily basis, if possible. So one useful tool for measuring this liquidity position of a depository institution is a net liquidity statement. So net liquidity statement lists the sources and uses of liquidity and thus provide a measure of a depository institution's liquidity position. So if you can remember in the last video, we have seen that as far as the sources of liquidity is concerned, a depository institution can use its own liquid assets. Depository institutions can borrow from the outsiders to just cover up the liquidity requirement, and the uses is it actually payout the claims of its depositors. So this liquidity statement essentially will list the sources of liquidity and how much of these sources has been used up already, so that how much liquidity sources is still available to face any liquidity issues. So here is an example. You can see that sources of liquidity is the cash type asset. For example, here $2 million, maximum borrowed fund is 12 million. One point we need to remember that to face the liquidity requirement, financial institutions can borrow from outsider. However, we need to remember that this borrowing capacity is not unlimited. Even if they can borrow only a limited amount of fund from the outsiders. So let's say that limit is 12 million, and excess cash in exchange settlement account. This essentially is the excess cash a depository institution hold in addition to any liquidity reserve requirement. For example, in some countries, there is a liquidity reserve requirement that a financial institution or a depository institution needs to hold a certain percentage of their deposit in liquid asset, for example, in cash or government securities. Now, a depository institution not necessarily hold exactly the same amount of cash required for the liquidity reserve requirement. They sometimes hold some excess cash. Okay. For example, when liquidity reserve requirement is 10%, $1 needs to be kept in liquid asset for every $10 deposit. Now, a financial institution or a depository institution may hold $1.5 for every $10 deposit. So this additional $0.5 is the excess cash, which is also a source of liquidity. So the total source of liquidity for the financial institution is 14.5. However, the financial institution has already used up this amount of liquidity. For example, it already has borrowed from interbank market is 6 million. It already has used the reserve banks, I mean central banks discounting is 1, so already used up 7 million. So its total, the sources of liquidity is 14.5. It already used up 7, so it still has a net liquidity left is 7.5. So this net liquidity statement is a useful tool that gives us an idea about the liquidity position of a depository institution. The second tool that we use to measure liquidity position is the peer group ratio comparison. In this case, the depository institution's liquidity exposure is measured by comparing certain key ratios and balance sheet feature of the depository institutions, such as loans to deposit, borrowed fund to total deposit, and commitment lend to asset ratio, with those of the depository institutions of a smaller size and geographic location. A high ratio of loans to deposits and borrowed fund to total asset means that the depository institutions relies heavily on the short-term money market rather than on core deposits to fund loans. This could mean that future liquidity problem if the depository institution is at or near its borrowing limits in the purchase fund market. Similarly, a high ratio of loan commitments to asset indicates the need for a higher degree of liquidity to fund any unexpected takedowns of these loans. Like high commitment depository institution often face more the liquidity risk exposure than the low commitment depository institutions do. The third tool for measuring liquidity risk exposure is the liquidity index. This liquidity index was developed by the US Central Bank, the Federal Reserve, but now it's been used by many other financial institutions. This index measures the potential losses and financial institution could suffer from a sudden or fire sale disposal of assets compared to the amount it would receive at a fair market value established under the normal market sale conditions, which might take a lengthy period of time as a result of a careful search and bidding process. So the greater the difference between immediate fire sale price and the fair market price, the less liquid a depository institution's portfolio of assets is. So depository institutions liquidity index is measured, you can see by this equation, where this PI is the immediate sale price and P star I is the fair market price of I asset, and W is the weight for each of the asset in the portfolio. Now you understand that this PI, which is the immediate sale price, if it is lower than the fair market price, then the ratio will be lower, and so the index, it means that the lower the index, the lower is the less liquid if financial institutions portfolio of asset is. So let's take an example of using this liquidity index. Assume that a depository institution has two assets, 40% in 1 month treasury bonds and the remaining 60% in personal loan. If the depository institution liquidates the treasury bonds today, it receives $98 per $100 face value. But it would receive the full face value on maturity in 1 month's time. If the depository institution liquidates its loan today, it receives $82 per $100 face value, whereas the liquidation closer to maturity, that is in 1 month's time, would lead to $93 per $100 of face value. So what is the 1 month liquidity index? So you can see that for the first asset, which is a treasury bond, financial institution receive $98 per $100. So this is 0.98, which is the immediate sale price, and 1 is the fair value after 1 month. And in the second asset, which is a loan, if it liquidates now, it gets $0.8. However, after 1 month, as it becomes closer to the maturity, we'll get 0.93. So the current price is 0.82, but 1 month ahead price is 0.93. And 40% is the weight of the first asset and 60% is the weight of the second asset. So you can see that liquidity index is 0.921. So this liquidity index value will range from 0 to 1, and the closer this value to 0 means less liquid a depository institution is, and closer this value to 1 will indicate that financial institution is more liquid. The next one is financing gap. This is the fourth way to measure liquidity risk exposure. So it determines the depository institution's financing gap. So as we discussed earlier, even though demand depositors can withdraw their funds immediately, they do not do so in normal circumstances. On average, most demand deposits stay at depository institutions for a quite long period, often 2 years or more. Thus, a depository institution's manager often think of the average deposit base, including demand deposits, as a core source of fund that over time can fund a depository institution's average amount of loan. So we define financing gap as the difference between depository institutions' average loan, and average deposit. So difference between the average loan and average deposit is the financing gap. So if this financing gap is positive, it means that the average loans is higher than the average deposit, then depository institution must fund it by using its cash or the liquid assets and or borrowing funds in the money market. So financing gap essentially will be liquid assets plus borrowed fund. So when expressed in this fashion, the liquidity and managerial implication of the financing requirement are that the level of core deposits and loans as well as the amount of liquid asset determines the depository institution's borrowing and purchase fund needs. In particular, the larger the depository institution's financing gap, the larger the amount of funds it needs to borrow in the money market, and the greater its exposure to liquidity problem for such a reliance. Now, B's approach, Bank of International Settlement. So far, we discussed the way of measuring liquidity risk exposure, but those are typically used internally by the financial institutions. But regulatory authorities, for example, Bank of International Settlement, have suggested to use a particular tool or technique to measure liquidity risk exposure, which one of these is maturity ladder. This approach is a useful liquidity measurement tool, and it involves assessing all cash inflows against its outflows. So the once identified, I mean all the outflows against inflows, a maturity ladder model allows a comparison of cash inflows and outflows on a day-to-day basis and over a series of specified time periods. Daily and cumulative net funding requirements can then be determined from the maturity ladder, which provides important information about the liquidity position of a firm, of a financial institution. For example, you can say it is a net funding requirement using B's maturity ladder. For example, this is 1 million, 1 day, 1 month, and 6 months cash inflows and cash outflows. So for on a daily basis, these are the expected cash inflows and these are the expected cash outflows. So you can see the total inflows is $54 million and total outflows is $50 million. So it has excess cash of $4 million available over the 1 day time horizon. However, if you look at 1 month's time, it has a cumulative net shortfall because its cash inflows is 750 and outflows is 800. So it has a cumulative net cash shortfall of $50 million over the next months. So the implication is the depository institution will need to immediately start planning to obtain additional funding to fill this net funding requirement. So over the 6 months period, the depository institution has a cumulative excess cash of 1.15 billion. So once again, the implication is if this expectation holds true, depository institution needs to find a place to invest this excess cash until those cash will be needed. The next tool that we are going to discuss is liquidity planning. Liquidity planning is a key component in measuring liquidity risk and its associated cost. Specifically, liquidity planning allows depository institutions managers to make important borrowing priority decisions before liquidity problems arise. Such planning can lower the cost of funds and can minimize the amount of excess reserves that the depository institutions need to hold. Active liquidity planning minimizes the risk that there will be not sufficient funds to either settle payments as they become due or to meet future loan demands. One point is depository institutions have different liquidity obligations, and a liquidity planning must incorporate all of these liquidity obligation, all of these different types of liquidity obligations. For example, immediate liquidity obligations, seasonal or short-term liquidity needs, trend liquidity needs, cyclical liquidity needs, contingent liquidity needs. So under the liquidity planning, when financial institution attempt to maintain adequate liquidity, they need to hold liquid asset for each type of liquidity obligations. First of all is immediate liquidity obligation. So immediate liquidity obligation occur in both contractual and relationship form. For contractual liquidity obligations, the depository institutions must have sufficient fund to repay in full all maturing liabilities. Relationship liquidity obligations relate to the strength of the customer-based relationship and satisfying the liquidity requirements of those customers through the provision of funds for new legitimate loan demand, which meets the depository institution's credit standard. Seasonal or short-term liquidity needs, on the other hand, is the liquidity required of a depository institutions to enable it to meet the demand for the liquidity that fluctuates with seasonal factors. For example, deposit withdrawal increases during December and Easter holiday periods, and in farming communities in spring because of the planting and fertilizing season, when loan demand rises and deposits fall. And in summer, for example, sale of harvest when deposit rises. So unpredictable needs can arise from large depositors and large borrowers that may influence short-term liquidity needs of a depository institutions disproportionately. Trade liquidity needs is the liquidity needs that relate to the trends occurring in the community where, for example, loan growth exceeds deposit growth. Right? So for example, a large proportion of age pensioner bank with the Commonwealth Bank of Australia, and as such, the Commonwealth Bank of Australia's liquidity increases significantly on pensioner payment day and drops gradually over the next 2 weeks until the next pension payments. Cyclical needs, on the other hand, is the liquidity needs that vary with the business cycle. For example, in boom economic conditions, depository institutions have high liquidity needs as loan demand grows rapidly and deposits decline as consumers spend more and save less. By contrast, during recessions, deposits tend to grow and loan demand shrinks. And last of all is the contingent liquidity needs, the liquidity needs necessary to meet an unforeseen event. So APRA requires that depository institution holds sufficient liquid asset to meet any crisis situation. So the bottom line is depository institution need to hold sufficient liquid asset considering all these different types of liquidity requirements. So in this video, we have discussed the way of measuring liquidity risk exposure for depository institutions. Thank you very much.